afternoon, everyone. Thanks so much for being with us on Market Sense on ET Now. I'm Megha Chadha.
Good afternoon, I'm Nikunj Dalmai. Here's a look at Indian markets. Nifty, it's trading with a negative bias. However, the small and the mid-cap indices are trading with a positive bias. State Bank of India is the showstopper today, 28.95, almost 2,900 rupees. Then you got Tata Motors and Asian Paints. So Asian Paints is up more than 6% in a matter of just 2 trading sessions. And auto stocks are giving State Bank of India and Asian Paints some company. So Hero MotoCorp is looking strong. And Maruti also is trading with a positive bias. But in macros, Megha, what is the story there?
Well, macros as well, Nikunj, not too much happening this morning. We've got the rupee trading a little range bound really. We got off to a good start and currently I think we are at that level of 61, 69. Even in terms of the yields as well, we are the 10-year yield right now. As you can see, the 10-year bond rather is trading at a level of 101.38. Meanwhile, if you see in terms of the overseas currency cues coming in, we've seen the dollar index then retreat a bit. So that's great, eased off some of those pressures from the emerging market currencies. Besides that, this week, remember, we are going to be getting the trade data as well for the month of October. So that's going to be rather important to keep your eye out on. Last week, we had a clutch of data coming through, the CPI, the WPI numbers, the IIP numbers. All of them, you would have to say, did manage to surprise us largely on the upside. And, a lot of chatter is beginning to be around when we will see the Reserve Bank really moving. The governor's been rather reticent, so we'll all have to, of course, wait and watch to see what really happens. But as always, every Monday morning, we've also got Maithili Bhusnamat, who's the consulting editor of the channel, joining in to take us through all the macro cues as coming in, as well as K Joshi, director-in-chief economist at CRISIL, as well, joins in on the show. Good afternoon to both of you. Thanks so much for being with us. Maithili, I just want to start off from the point that of late, the data that we've had coming in last week has been positive. No bad surprises really coming in there. But do you think it's a little early to call whether we'll see the rate cycle really move in favor of the way the industry wants?
Yeah, I would guess so, Megha, because I think the Reserve Bank is yet to be convinced that the prices have fallen on a sustainable basis. Moreover, I think when we get the trade data this week, I think we are going to get some slightly negative data to offset the positive data that we got last week. Because if you remember, September, the trade deficit was already at a pretty high 14-month high. So October data is likely to be even more adverse because for the simple reason that even though oil prices had eased, gold imports had really shot up. India has overtaken China as the largest importer of gold. So my guess is that maybe October data as far as the trade deficit is concerned would not be that robust, and even though broadly speaking the current account deficit would be within a very comfortable less than 2%, I think overall it's a little early to say that we're out of the woods, particularly as we see the external environment. We've just seen Japan, the third quarter GDP, show a decline, so I think it's a little early to call it as a victory over inflation.
Mr. Joshi, the big data this week is going to be trade data, and given the kind of gold imports we've seen in the festival season, what are the chances that the trade data could actually disappoint?
Well, I think trade data will not be very encouraging. I mean, let me put it this way. Though I think major kick, the positive news is on the oil front. Oil prices have actually come down very significantly, and that will reflect in our slightly weaker import numbers. But the gold, as Maithili was pointing out, I think is on the rise again. The imports are on the rise again, overall, I think it won't be very positive. The trade data, I think, because the other economies where we export to are also slowing down, particularly Europe and Japan already is reflecting a slowdown. The only stronger part of the world resides in US. I think apart from that, I think the other economies are going to grow slower than what was expected earlier. So I think trade data would be of concern.
Dr. Joshi, trade data is closely linked, as you said, to what happens all over the world. And as you very rightly pointed out, the US economy seems to be the only one that's recovering. So can the global economy really fly on one engine, as many people have argued? Or is it that we also need some kind of growth to happen in the Eurozone and Japan as well?
I think we need both Japan and Eurozone to come out of the recession. Japan has already again slid back into recession. They have postponed their consumption tax also, and I think they are going to continue with super loose monetary policy to offset the fear of deflation. And Europe actually is turning out to be much weaker than was expected earlier. I think S&P's outlook for Eurozone was 1% growth, and I think it's still at that, but the risks to that growth are increasing because the most industrial parts of Europe are not doing well. Germany hasn't done as well as was expected, and Italy anyway is very weak, and France also is becoming weaker by the day. So I think Eurozone will continue to remain a challenge, and China on the other side, on the Asian side, is going to struggle to get to 7.5% GDP growth this year. So there is a concern on the export front. I think fortunately the domestic industrial activity hasn't revived in a big way. Otherwise the trade deficit would have been much higher because the import intensity of our manufacturing is quite high. So because the domestic economy is not booming, I think the trade deficit would somewhat be under check. I think the problem will arise when the domestic economy starts moving up and the industrial activity starts, which will be a good news or a good problem to have. But I think at that time our imports will increase much faster, which is not happening currently.
Absolutely. Absolutely, you hit the nail on the head that Indian economics is always on the one hand, on the other hand. That is why that snipe about two-handed economists. But keeping with the global economy, how do you read the G20 statement? Do things like the G20, are they more than a talk shop, or does it really result in something to really kickstart the economic growth all over the world?
Well, I think the policy tools available with the advanced part of the world, particularly Europe, I think they are structural in nature. I mean, you cannot push these economies up merely by cutting interest rates. Interest rates are already too low, and structural reforms are always difficult to come by. Europe doesn't have a burden-sharing mechanism in place. The stronger parts of the Europe do not necessarily support the weaker parts. Without that, I think the problem is that the ability of the Eurozone to decisively come out of weak growth will always be under question. So I think Eurozone needs to take more structural reforms ahead. I think that probably would be the solution to their problems, and those are not very easy to push forward because of, I think, varying interest in Eurozone itself. So
turning to the domestic economy,
has been raising the issues. Sorry, carry on.
Absolutely. But turning to the domestic economy, how do you read the remarkable decline in 10-year bond yields? How does it really gel with our macroeconomic fundamentals, which actually have not really improved that dramatically? Is it entirely liquidity driven, and can that also be sustained?
Well, I think it is liquidity driven, but also I think the fact that inflation has come down and has come down much sharper than expected, I think that's also leading to lower bond yields. And I think the government's fiscal situation, I think, has not been that bad. I mean, in the sense that we've benefited quite a bit from lower oil prices, and that has reduced the pressure for government to come out with fresh debt. And I think so they are broadly looks like, I think the target of 4.1% seems feasible. And I think inflation coming down, too much of liquidity, not too much of credit growth, I think all that is leading to a low interest rate or low bond yield scenario, which I think is likely to persist for some more time.
So does this make a mockery of RBI's monetary policy stance? Because the RBI does not want to reduce interest rates, but we've seen 10-year yields falling, we've seen banks cutting their deposit rates at the lower end. So what is the RBI trying to signal at all? If nobody is listening to the RBI, then what is the RBI trying to do?
Well, I think the transmission may be weak, but I think if you look at when RBI was raising interest rates, even then the interest rates in the market did not go up that sharply. So I think there is some asymmetry in the reaction, and right now I think it is liquidity driven. And when next year if US raises interest rates, I think that will put some pressure on our bond yields. I think going ahead, even if inflation remains much more benign than is expected. So I think the bond yields are soft definitely right now, but they could move up a little bit also, I think, if and when US interest rates rise.
All right, Mr. Joshi, Metli, thank you both for joining us. 90 points down for the bank Nifty, and this is happening on a day when HDFC Bank is down 2%, but most of the PEs